Hi, and welcome to this week's episode of Retire Right with Epstein White. As always, I'm Brad White.
And I'm Dave Epstein.
And we are, fast into September here. Before we know it, we're going to be doing, year-end planning?
Yep, daughter's back to school.
Yep, son's back to school.
We love that, and she's busy. And being a sophomore at San Diego State.
Which means Dad's not the only one working anymore, that's right. Get back there, get in school. So, everything's good, and life is good, and hey, the show is hopefully good too, right? We've got hopefully another great, exciting show for you, armed with a whole bunch of tips that we can really just arm you with, teach you with, on how to better prepare yourself as you enter into retirement, right? And so we're going to start off with a weekly retirement alert, which is mutual funds exposed, right? So not the first time we've talked about mutual funds, something very interesting on today's show that we're going to alert you to. Then, as always, we have our viewer question of the week, and I thought this week's was a great one. One of our viewers is, hey guys, I'm pushing retirement here. I don't want to put my money in risk. I'm sitting in a lot of cash. What are my options? What can I do? So we're going to go ahead and teach you what your options are.
Hey, Bradley, wringing every nickel out of your Social Security options, hugely important. Over 70% of Social Security beneficiaries get this wrong, Brad. And really, it's not just about the Social Security option, but how to integrate it with retirement, everything else that makes you, to wring a nickel out of not only Social Security, but out of your retirement. So really important segment there. And tax deferral, Brad, got to be careful about that tax deferral. It's great while it's growing. No 1099 along the way. But watch out, when it comes out, it's all ordinary income.
All right, without any further ado, let's get going. There's a lot of things to like about tax deferral. Even the word itself, or words itself, kind of lets you know that you're not paying tax right away. So inherently, right, Dave, that's a nice start, right? We know that we like tax deferral. That was really the whole mission behind things like your IRAs and your 401ks, was not only to get that tax deduction day one, but also to make sure that every single year as you're hopefully earning money, whether that's through things like dividends or interest, or whether that's because you're buying and selling things and having capital gains. The point being is, if you had capital gains or dividends or interest and you had to pay those taxes each year, then you would have less money to earn money each year. So again, on top of just the tax deduction of something like a 401k, another great feature is the tax deferral. It means that you don't have to pay any of those taxes along the way. You just keep deferring, keep deferring, keep deferring. So all that's great, Dave, except watch out. Right?
Watch out. Do you really want to double up, folks? You got all this money, hopefully you're socking away in your 401k or in your IRA, or is equally as important, your Roth IRA, okay? But that money, that's perfect money to payroll deduction if that's how you're doing it at the company. Or this after tax, this question that we're asking, or really giving you the answers to, tax deferral with my non-retirement accounts, doubling up there, Bradley, that could be painful in retirement. Money coming out of IRAs, money coming out of tax deferred accounts, all taxed at the worst rates, Bradley, at ordinary income tax rates.
And that's really the watch out part of this whole equation, which is just at some point, everything comes to roost, and the IRS is certainly no different there, which means every dollar you start pulling out of things like your IRAs and your 401ks is going to come out taxable as ordinary income. The more you pull out in any one year, the higher and higher rates that you'll be taxed at as you pull that money out. So right off the bat, it's just a lot of times people kind of wake up and realize, it says I have $500,000 in my 401k, but make no mistake about it, you haven't really saved $500,000. So one of the initial things we're kind of alerting you to here is just the simple fact is, if most of, not all of your retirement savings is in tax deferred accounts, please understand, unfortunately, you didn't quite save as much as you thought you did, so we've got to be a little bit aware of that right out of the gate.
Mean I got a partner in that money, Brad?
You do have a lifelong partner.
I have a lifelong partner.
Yeah,
and it's not your spouse.
No,
it's Uncle Sam.
It's Uncle Sam. Not much of a relative. Is much more my preferred lifelong partner there, right? Than Uncle Sam certainly is. So just a little bit of kind of a tongue-in-cheek there, but again, that's important to realize certainly that you don't have as many funds and you haven't saved up quite as much as you thought. But what it also does is we see this time and time again is it really leaves people handcuffed, right? At some point, life happens in retirement as you want $50,000. Unfortunately, it might be for an emergency, right? Maybe the roof breaks or maybe your kids need some funds or something along those lines. And it's a real burden to have to always pull money out that's taxable and again, taxed at higher and higher rates. Now, this is one of the reasons why when you hear the word diversification, yes, we want you to diversify in your investments, but we also really want you to try to diversify in your tax accounts as well, right? We want you to try to save up in non-IRA accounts and ideally things like Roth IRA accounts, so it's coming out tax-free when you pull that money out, which is the exact opposite of kind of watch out when it comes out.
That's a different kind of diversification, folks. From a tax perspective, diversifying the sources of where you're going to get income from. And hugely important. That's a great point, Brad.
Right. And so kind of one of the things that I want to paint this picture of too is, look, along your life, as you're still building and you're still saving, really try to stop and save in money in your just non-retirement accounts altogether. That provides you a lot of liquidity, and it will allow you in the future to be able to grab money tax-free. You get your own after-tax money back to you, and it's completely tax-free. Not to mention, if you build a solid retirement plan, and we can keep you in things like under the 15% marginal bracket, it means in those type of accounts, we can structure things like dividends for you that you can collect, and those dividends can be tax-free. So if you put those dividends in a tax-deferred account along the way, they're coming out as ordinary income. Believe it or not, if you can diversify and have some after-tax accounts, we can actually do some tax planning in retirement where those dividends can be tax-free, and once again, anything and everything would come out of a Roth IRA, 100% tax-free. So one final message here, Dave, is a lot of times while people are working, they'll take non-IRA retirement accounts, money that should be after-tax money, and they might put an investment in there like a variable annuity or something to that effect, and people get sold on doing this because the variable annuity will also grow tax-deferred. And you're thinking, great, I've got a whole extra source of tax deferral here. But what you've really done is you've taken this kind of precious after-tax money, this money that you could have used later on to provide all sorts of efficient tax planning and retirement, and you've trapped it. Now you've doubled up. Now you have all of these IRA and 401k dollars that are already tax deferred and already coming out taxable as ordinary income, which is a burden, right? It's a handcuff. We just talked about that. And now all of a sudden, this other money that you actually did have diversified into after-tax funds, you've gone and chosen a tax-deferred investment that's only going to double up, and it's going to make you once again have to watch out when you start to pull those monies out, because you're in for a really rough kind of retirement here forever as far as from a tax standpoint, never feeling good about a place to pull your money from.
Yeah, you really want that balance, folks, where you can pull money and get efficient, certainly liquidity, and get it at a much lower tax rate than IRA or retirement dollars. It's nice to have both, and boy, just throw Roth in there in the mix too. Now we got a beautiful structure.
Right, so the bottom line is there's a lot of things to consider here. Sometimes tax deferral can be perfect. Other times we want to teach you reasons why you wouldn't do it. And it's all a part of an overall retirement plan. And that is something that our office is happy to help build for you and help guide you through. Just give our office a call, come to the website, and we'll build that for you.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you want to manage it. Use it to fund your dreams. Make sure it lasts as long as you need it. And make sure it leaves a legacy for those you love. So what do? Wall Street continues to be uncertain, and many conservative options have all but dropped through the floor. How do you maintain opportunities for growth without risking what you can't afford to lose? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies, estate planning solutions, and guaranteed retirement income you cannot outlive. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a special free guide entitled 10 Things to Know About Retirement Income, simply contact us today.
Well, folks, viewer question of the week. This is one of my favorite segments. Boy, if you've got a question that's keeping you up at night, or you just can't seem to get the right answer to, send it in to our website. And if it's a good one, we'll pick it. We'll use it just like the one we're going to use right now, where a viewer last week, very common that we see this, and and have been seeing this for a number of years now, in that, hey, I'm sitting in cash. I've got a lot of money sitting in a bank, and gosh, I just don't want to risk it in the market. I'm older. I can't go back and make this money again. is there a safe place where I can make some interest these days? And boy, that's a great question. We see a lot of people who feel like they're in purgatory, actually. You know, since March of 2009, stock market's up 260+%. Interest rates, boy, interest rates, you'd have to go back to the 1940s to find an interest rate period so low. Almost the perfect storm if you're entering retirement or you're already retired. And so we get it. And so what I want to do now is I want to teach you, the characteristics of investments and really the perfect investment. I want you to look at this graph that's right behind me. And it's really telling. It's really the three characteristics that we'd love to see in any one investment. We love it when we put our money into an investment where it's safe. We know we can't go down or backwards. We can't lose our money. And certainly liquidity. Liquidity is important to know that you can get to some of your money or a lot of your money without fee or penalty. And lastly, rate of return. We always would love to make a rate of return. But can we get all three in that one investment? And the answer is no. In fact, all investments will typically do only two of the three well. Or saying it to you this way, all investments do at least one thing poorly. And so if you're that viewer who's watching right now and we're addressing your question, I'm older, I've got money sitting in a bank, how do I make a rate of return? Well, obviously, you want your money safe. You want that characteristic. And yes, you focused on liquidity where you can get to the money, but you're getting no return. And folks, today it's not uncommon that we see money sitting in a bank getting 1/10 of 1%. So, okay, so let's give you that answer that you're looking for, Miss Viewer out there. And now, if you're just getting 1/10 of 1%, and the question was, I have $250,000 sitting there, kind of going broke safely, not really even keeping pace with inflation. If I was only getting 1/10 of 1%, at the end of 5 years, and if I was looking at a 5-year period, my $250,000 would have grown to $251,252. That's not keeping pace with inflation. That's going broke safely. Well, what if you can get 3.15% interest? What kind of difference is that? Well, over that same 5-year period, that worked out to be almost $292,000. That's a $40,000 difference, a $40,000 difference for keeping your money safe and guaranteed. That's just a phone call. That's a phone call that you can make, or just go to our website. If you're feeling like you're stuck in purgatory and unwilling to put your money in the market, but you've been holding your breath for years now on hoping interest rates will rise, well, here's a great way we can get your money working for you, okay, without putting that money at risk. And that's what I love about this particular rate. It's guaranteed, it's safe. Yes, we're going to get a good rate of return, but we're just going to give up a little liquidity in this investment, remembering all investments do one thing poorly. In this one, we're making a time commitment, okay? Just like you remember you used to do when you used to go down to the bank and make a 5-year commitment. And remember when the bank used to be able to pay you 5 or 6%? Well, those days are history, long gone, okay? So here we're going to not make a risk commitment. We're going to make a time commitment for 5 years. But in this case, the best rate we know here in the country, 3.15. So if we could help you, just give us a call here at the number you see on the screen, or go to our website, and we would be happy to help you and ensure that you retire right. Mutual funds, a lot of people have them, and we're great tools to save money. Certainly when you're starting out in life and you're just getting your savings going, mutual funds can be a very powerful tool. First created way back in 1924, when the average savings of a family was $5 a month, and GE, a share of GE stock was $16. But Bradley, fees, flexibility, taxes, those are some of the inefficiencies of a mutual fund, and people are really unaware of paying other people's taxes in a non-IRA account. Sure. That can happen.
Yeah, certainly.
How flexible can I be? and certainly fees not so transparent in a mutual fund. And so that's really what this segment is about, is educating all of our viewers in what to look out for when purchasing a mutual fund, and what can you be looking to as a way to become really educated about making the right choice. And it really begins with a plan, Bradley.
Well, maybe of all those things, I kind of like the tax part of it. I think people kind of in general, recognize that there's some fees in mutual funds. We'll talk about that in a minute. The tax part's a bit interesting. Most people don't know this, and this is important. Now, what I'm about to describe to you, these tax implications only exist in your non-retirement accounts. Okay, so if you have IRAs or Roth IRAs, anything that's bought and sold inside of there stays tax deferred. So what I'm about to describe is only for non-retirement accounts, okay, where things like capital gains come into play. And unfortunately, when you own mutual funds in those type of accounts, you actually pay other people's taxes. And if that sentence alone doesn't grab your attention,
right,
I don't know what will, and hence the reason that we're going to talk about.
I mean, it's tough enough to pay my own taxes,
yeah,
Bradley.
it is tough enough, right? We got to pay our fair share, but the point is, let's not pay more than our fair share, right? Like, let's be legal, let's be on the books, but let's not pay more than our fair share. Certainly not other people's. Okay, so what are we talking about here? Remember, the one mutual fund might have, let's say, 100 stocks inside of it, okay? But you don't actually own any of the stocks. You only own a little piece of this fund, and you mutually own it with hundreds of thousands of other people. So you own little tiny shares of that. Now let's say, hypothetically, one of those stocks was Coca-Cola, and it was bought at $80 a share, and then it did well, and it went to $90 a share, and that happens to be the day you buy into the mutual fund. But then something happens to Coca-Cola, and it goes down to $85 a share. And then for whatever reason, the mutual fund managers decide to sell Coca-Cola. Now remember, you got into the mutual fund when it was at $90 a share, and it was sold when it was at $85 a share. So your experience in this one Coca-Cola stock was a $5 per share loss. Here's the problem. You're going to pay a $5 per share capital gain. You're going to pay taxes on that $5 per share loss. How the heck could that possibly be, Dave? Remember, the mutual fund bought Coca-Cola at $80 a share, and it was sold at $85. So the mutual fund itself experienced that $5 per share gain. You were the unlucky person that happened to be in the fund at the time it was sold for a gain. So even though your experience was losing money, in that example, you pay somebody else's capital gains, basically, let alone if you bought the mutual fund for a price and sold the mutual fund for a higher price later on, you'd pay a capital gain on just the mutual fund gain itself, let alone the underlying potential gains from the different stocks and things inside of the fund, Dave.
And what you just said there, Bradley, that loss that you experienced, that loss didn't really pass through to you.
Oh, that's a great point. So what Dave's referring to, right, is that inside of the mutual fund, certainly some stocks could be sold for a loss. The problem is the way the structure legally works of mutual funds is when losses happen inside, losses don't pass through to the investors to help you offset capital gains you may have had in other areas of your financial world. So you're getting hit really on a double-edged sword, right, when it comes to that from a tax standpoint. So again, in non-retirement accounts, if you've ever just gotten this big litany of 1099s and the Always Fund revised 1099s, as it's coming closer and closer to tax time every year and you're trying to rush and get yourself organized, there's just hundreds and hundreds of potential transactions buying and selling all the time inside of the mutual fund.
Fees.
That creates fees.
Right.
Every time a stock and a bond is bought and sold, that's a trading fee that you pay. Plus they charge an annual management fee per year called an expense ratio. That is what the mutual fund makes. Then there's different letters next to the mutual funds called share classes, which means the mutual fund is going to create the same exact fund with the same exact investments, but the difference is how other people get paid. So brokers could get paid on what's called an A or a C share class. You can buy cheaper versions of funds on institutional investment advisory share classes. So you've got not only fees on how the mutual fund's making money, but then depending on how or who you buy the funds from, could be just basically more expensive or less expensive versions of the same exact thing.
And Bradley, those fees and expenses that you're just talking about, are they deductible to you, or can they be deductible to you? Well, expenses of fees, those brokerage fees with a broker are not. They're commissions. But if you're paying a fee with an advisor, an advisory fee, those fees can be deductible.
Very complicated stuff, right? How do you know if a mutual fund is right for you or if something else is better? How do you know which of all of those versions is best for you? Right now is a fantastic time for a review and a second opinion on all of your investments. Give our firm a call, come to our website, and we'll be happy to give you that all-important review. Hi, Brad here. Hope you're enjoying the show, Retire Right with Epstein and White. You know, taxes are complicated, and they only get more complicated as you're heading into retirement. But there are a lot of strategies, a lot of tips, a lot of things that us as a firm that we do all the time to help you minimize your tax situation as you're heading into retirement. So take a look at the number below, give us a call, come to our website, and come and see us. And we are happy to teach you all the things you need to know in order to minimize your taxes in retirement.
Social Security, core benefit for when you retire. Over 70% of Social Security beneficiaries get this wrong, folks. We don't want that to be you. We want to make sure you wring every nickel out of your Social Security benefit. You've been paying into it all these years. Bradley, you know, that would be a huge waste to leave literally tens of thousands of dollars, maybe as much as $100,000
or more even
of lifetime benefits because you just didn't get the right education.
You know, and okay? I think honestly, when you put it in perspective like this, I don't know how many tens of thousands of hours over your lifetime you've worked. I mean, if you've been working from your 20s through your 60s, that could be hundreds and hundreds of thousands of hours. Every single paycheck, right, that you worked so hard for, you had to pay some taxes, some FICA taxes, some Social Security taxes. So you've been putting your own hard-earned money away every single paycheck for 20 or 30 or 40 years into this. What's another hour with really a Social Security expert to help navigate you through what is, I assure you, a very, very complex system with a lot of different rules and options and strategies and timing differences and taxation differences, and the list goes on. So that's really, if nothing else, before we kind of get even into the, you know, the meat and the potatoes of what we're about to teach you right now, I just really hope that sinks home with people, which is all the hundreds of thousands you were willing to work, essentially, to kind of get you through your life and set yourself up in retirement. Another hour on a topic of Social Security goes an incredibly long way. Now, you hear us say that because we're going to spend the next couple of minutes really giving you as many highlights as we can, but everybody's situation is very different, right? If you've watched this show before, a few weeks back or a month or so back, we talked a little bit about Social Security, but we want to reiterate a couple finer points today. So just a couple real finer points. You know, if you've worked 40 quarters in your life, so if you've worked 10 years, then you are in the system, you have a Social Security benefit. But that's not really the whole story of that calculation, right? As far as what your benefits actually look like, how are they arriving at that benefit? It's based off your highest 35 years of pay. Okay, so if you take the best 35 earning years of your life, adjusted for inflation, that is going to be a part of a very complex formula, which tells them basically how to calculate what your benefits are going to be. So then there's this proverbial question, right, Dave, which is, you know, I get a bigger paycheck if I waited all the way until, let's say, 70. Right.
If I've been to live a long time, that would be, the Social Security expert would tell you if you're going to live a long time, and this benefit is the greatest at age 70, that's the only choice that you should make, Bradley. But boy, what if you wanted to retire earlier?
Yeah, and so what Dave's referring to is the fact that you can wait until 70, and that's the latest you can wait for your Social Security check. That's when it's maximized. Or you could take a smaller check as early as age 62, and every month along the way, that check gets a little bit better if you wait. Now, if you just look at Social Security in a vacuum, there's this thing called the break-even analysis, which says if you wait until 70 to get your much larger check, you have to live until about 80 to break even with those missed years worth of payments. Another way of saying that is every year you live past 80, you do get more Social Security dollars over your lifetime because you waited as long as you could to take it. But that's only if you look at it in a vacuum. If you start to apply things like the time of which you want to retire, what's the size of your investments or not in your tax savings, this is what our firm specializes is we can teach you that for some of you, even if you live a long time, it's better to take Social Security early. But for others, with those different circumstances we just mentioned, we can teach you that it is much better to live late. So this break-even analysis, kind of looking at it in a vacuum, is not the most important thing, but it's certainly important for you to understand that that age 80 concept is kind of this general break-even analysis. And again, come see our office and please visit with us as Social Security experts and financial planners to teach you kind of how to wrap those other elements into play. But then we also have things like spousal rights if we're married, Dave.
Yes,
right?
you know, boy, is there some great opportunities there on switching techniques if you're married. Switching techniques, and you better know this, because Social Security, they're not going to call you and tell you, now it's time to switch from your spousal back to your own, which has grown to be a greater benefit. And so this is where people fail to wring every nickel out of Social Security. These switching techniques, these spousal options that are out there for you. It's just, Bradley, getting the education.
Exactly.
So when you go into Social Security and you're in front of that window and you're handing in your paperwork, you want that paperwork to be exactly correct. You don't want that to be wrong. They're not there. Fine people down there, Social Security, helping their families, working hard, but that's not their job, Bradley,
right,
is to do financial planning for you. So huge.
Yeah, so if you're currently married, there are spousal rights for you. You can collect up to half of your spouse's Social Security check, even if you've never worked a day in your life. Now, how does that affect your spouse's Social Security check? It shouldn't. They should be able to keep their entire check, and you should be able to collect up to half of theirs. But there's other rules in play here. It depends on what age you try to collect a spousal benefit, whether your spouse is filed or not. And as Dave mentioned, there's a few other strategies that you might be grandfathered into, depending on what year of birth you're in, where you can get half of a paycheck plus let yours grow. By the way, when it comes to taxation, Social Security is either not taxed at all or as much as 85% can end up on your return. So it's a very complicated system in general, but don't worry. We've done the research, we've taken the time, we understand every option, every strategy of the system, and we understand how to apply those Social Security strategies to the rest of your financial plan. So give us a call, come to our website, and we will help you maximize a crucial benefit, which is Social Security for your retirement.
Well, that's all the financial fun we have for you this week, folks. We covered a lot of information, you know, the inefficiencies and structural problems in mutual funds. And boy, if you're sitting in cash, and you've been sitting in cash for years waiting to get some interest, well, there's no interest out there, Bradley.
Yeah, you know what? Yeah, I thought we covered a lot of great stuff on today's show. And make sure you tune in every single week, same time, same channel, because that's our mission is each and every week to bring a lot of great content for you to help you retire right. So you'll see our number on the screen and our website. Give our office a call, come to the website, and let's see what we can do to help you retire right.